Oil jumps as President Trump orders a blockade of Venezuela. President Trump has ordered a blockade of sanctioned tankers entering or leaving Venezuela, although it's not clear how that would be enforced. The market is anticipating more disruption to Venezuela's exports, which have already fallen sharply since the US seized a tanker off the country's coast last week. Naveen is a senior analyst at Kpler. Naveen, how much would an effective blockade on all sanctioned tankers disrupt the supply?
That's a great question. And as you mentioned at the top, the enforcement of this blockade is also very key. As it stands, Venezuela produces about 900,000 barrels of crude and condensate, of which we see about 760 to 770,000 barrels exported globally. Of that portion, about 580,000 to 600,000, so call it 75%, three-quarters of that does flow on sanctioned tankers as sanctioned entities to the Chinese market, the Chinese independent refiners. What is crucial to note is about 17%, about 130,000 barrels goes to the US. So these will not be touched. So if there is an effective enforcement of this blockade, we do see around 600,000 barrels of Venezuelan crude typically going to China be affected. Now, the market has jumped off the back of this, and with these headlines, there are short-term price spikes. Nonetheless, the effect of this in general, I think, will be absorbed by the market, quite muted. And one of the key reasons for that is the access that Chinese independent refiners have to other sanctioned barrels, notably Russian and Iranian. Currently, we see around 42 million barrels of both Iranian and Russian oil in floating storage, some of it very close offshore China as well. So in general, any sort of disruption, if it is enforced, and that is key, could be absorbed quite readily by the market and replaced by other sanctioned barrels.
What about a longer-term interruption to Venezuela's exports in the case potentially of conflict or of a US invasion? Could that push the price up?
That's a very good point as well. I think there are two factors to look at here. I think in the immediate aftermath of something like that, you would see a short-term price spike. We would see markets react to some sort of disruption as bullish and push the prices up, I would say, in the short term, days to potentially a week, to see how that conflict escalates. However, going forward, any sort of invasion does imply a toppling of the regime, some regime change. And I think the market would then settle into viewing this as maybe longer term more bearish in terms of how Venezuelan oil and Venezuelan oil reserves could be exploited and to actually boost the supply going forward into the market. So I think there's definitely two factors to this, one short term and one more medium term, longer term.
That's very interesting, isn't it? Because Venezuela's oil reserves are, of course, the largest in the world. If they were to be opened up to foreign investment, how easy would they be to exploit? How much could Venezuela's output be increased?
Well, there's definitely a timing element to this. In the view of a regime change, I think very quickly, so within the first year, you would see a lot of foreign interest and foreign investment to tap into those massive oil reserves, as you mentioned. Within the first sort of year, 12 months to maybe 18 to 24 months, we could see with foreign investment, Venezuelan oil output increase by about 200,000 to maybe 300,000 barrels. But again, I think more crucially, looking at the medium-term horizon, maybe over the course of 5 years, you could see upwards of about 1 million barrels a day of additional Venezuelan supply, which comes onto the market, or which could come onto the market at a time when there are other natural field declines in other output basins and other regions of the world. So Venezuelan output under regime change could be a massive, massive factor that could color the oil markets in years to come.
But is the global market at risk of being so oversupplied in 2026 that investing in Venezuela wouldn't be worthwhile, even if it were possible?
That is a fact. We are seeing at Kpler an oversupply in the market of about 1.8 million barrels per day. Now, what is crucial is that has been gradually sort of revised lower as the year progresses. More recently, we had it at about 2.3 million barrels a day. So 500,000 barrels of a reduction of that surplus. Partly where that surplus goes to is also a key question in determining price. Should a lot of that surplus be pointed at Chinese stockpiles, the market would deem this as being additional incremental demand, which could support prices. In a supportive price environment, even in a surplus, we could see investment in oil production and to extract oil, especially in a world whereby you do see in the medium term some field declines, which could result in declines going forward.
That was Naveen Das of Kpler. Don't forget you can watch more videos on Reuters.com.